Hello, everyone, and welcome to our webinar. Today's webinar is titled ERISA, Real Life, Real Mistakes to Avoid. We are thrilled that you have taken time out of your busy schedule to sit with us today. Hello, everyone. My name is Steve Jackson. I'm the Senior Vice President of Broker Concierge here at PrimePay, and we want to welcome you here to today's webinar. This is an important topic. ERISA over the many decades has been a huge enforcement issue with the Department of Labor and primarily EBSA, which is their enforcement agency. So we do want to get started with some of the summary of enforcement actions that are being taken place here today. But we also want to talk about ERISA and their requirements as it pertains to health and welfare benefits. All right. And so today we have kind of broken this up into three areas entirely. You'll see this first one, which is number 2 here, the top ERISA document mistakes. We have performed many ERISA compliance functions here at PrimePay over the last many years, and we thought we would highlight some of the key ERISA document mistakes that employers make consistently. It'd be good for you, right, as the benefits consultant to be able to recognize when specific mistakes are being made. Number 3, or the second item we're going to talk about, is the top 5,500 filing mistakes. Wow, I guess I was very naive early on. I figured, oh, these employers, they're doing the right thing here right out of the gate. And we are finding that that's not necessarily the case. Many employers are making minimal types of mistakes. But those minimal mistakes can actually cost up to a tremendous amount of money in penalties. So let's talk about some of the top 5,500 filing mistakes that are occurring. And then we are going to bring in a case study. So kind of the third key item today we want to bring to life for you is a complex 5,500 remediation case study, a client that we reviewed and performed a complete analysis. And we're going to kind of showcase through this case study the problems that were found and then the specific outcomes or the remediation aspects that took place to bring them into compliance. You also might be asking yourself, well, all right, I don't know, I haven't really been talking to my clients much about this particular topic over the last couple of years. So we do want to bring to you just a few questions that you can use in addressing this specific requirement with your client. And then we also will want to hear from you at the end. So we'll give you an outlet here in how to reach out to us with some specific questions that you may have. So let's kick things off here in regard to the key enforcement actions. You know, in talking with your clients, it's not as easy to just sit there and say, well, there's a 100% guarantee that you're going to get audited. So make sure that you have this stuff done, right? Yeah, you may not be able to just state that, right? Because we can't guarantee that every employer is going to get an audit. They certainly won't. But you do need to understand their oversight. And the Employee Benefits Security Administration is really focused on the enforcement activities under the Department of Labor. And their oversight actually extends to over, I think it's about 680,000 retirement plans, and it comprises of over 2.3 million or 2.2 million health plans out there today. And then when you factor in a similar number of welfare benefit plans such as life and disability insurance, right, you can see that this number is even going to escalate, probably even double from what I have listed here. But their oversight extends to a couple million plans that they're going to be touching, year end and year out. And when you look at what EBSA has ultimately recovered, right, through their investigations, they recovered back to participants over $1.1 billion here in fiscal year 2018. And you might say, well, Steve, I mean, that's a decrease from the previous fiscal year there from 1.6 billion. Yes, there has been. But when you look at that here over the last 5 and 6 years, that actually is an 83% increase. And you can see from these numbers each year that they are successful in what they are doing, okay, and how they're going about it. All right. So they were over 1,300 civil investigations. Okay, so this is even outside of what EBSA and the Department of Labor may actually enforce. So these are civil investigations, and over 860 of those, or 64%, closed with monetary results alone. All right, so what EBSA is looking for, right? They often want employers to pursue voluntary compliance. And they want to do that as a means to correct violations and restore losses. All right. And so EBSA's Voluntary Fiduciary Correction Program and the Delinquent Filer Voluntary Compliance Program, or the DFVCP, it encourages the correction of violations of ERISA by providing significant incentives for fiduciaries and others to self-correct. So it's encouraged by EBSA that employers recognize where they have been found to be delinquent and to ultimately utilize this program in order to achieve some significant incentives, right? Meaning that maybe penalties will not be as severe. And I'm going to highlight some of this here in the case study that I'm going to bring to you. Well, in the last fiscal year, there were actually over, close to 20,000 filings, all right, that were used to bring their plans ultimately into compliance. So the enforcement actions are real. That's a real life. So now let's talk about some of the key mistakes that are being made. And the case study then will bring to life how these can be remedied. So they can be all avoided. But let's talk about some of these key mistakes. And the first kind of section that I want to cover with you is the top ERISA document mistakes. All right. And so when we look at the universe of compliance mistakes that we see both in the disclosure and the reporting requirements of ERISA, there are many. All right. But the number one mistake we see across the board, and this goes from small employers to very large employers, and it's the absence of a plan document, an SPD, so a summary plan description for each component benefit, or that there was not a wrap plan created as a document for all of those benefits. So you see here in the first bullet, not having plan documents at all. And we run across those employers who actually have implemented flexible spending plans, right? A health FSA and also HRAs, which fall under Section 105. But it also includes self-administered FSAs and HRAs. You know, many employers end up outsourcing the administration for their FSAs, flexible spending plans, and health reimbursement arrangement types of plans, you know, to third parties. They do that many a times, and those third parties will create the necessary plan documentation that's needed. But there are employers that also self-administer, and many of those plans are just left off of this list. And so including all of those component benefits is a fundamental requirement of ERISA from its inception. So by far, not having plan documents at all, if an auditor were to walk in that office, your employer's office, and say, oh, great, I see that you're offering a medical benefit to your employees. I would love to see your plan document. All right. So if you can't produce a document, which is a specific requirement, the kind of statute, right, under Title I, I mean, it must be written, then you don't have a plan actually at all. All right. The second most frequent failure is to distribute a summary plan description to eligible participants. So I want you to keep in mind that this includes not just an eligible employee, right? It includes qualified COBRA participants and their beneficiaries. It includes any retirees or retiree spouses or dependents that are eligible under the plan. Or it could also include any dependents covered under a qualified medical court support order that could also be there. They must receive one of these summary plan descriptions. So you also want to keep in mind that a summary plan description is different. It's a different document versus the plan document. All right. The summary plan description is going to be that key document that would be distributed to the employees that will discuss all the various disclosures, notices, plan language, eligibility, waiting periods, all of those things will be listed within that summary plan description and must be included. So a top mistake is the failure to distribute the SPD, and most employers would not have an SPD to distribute, and that's the reason why they do not have that plan. Plan documents and SPDs do not have all of the required notices and language that is generally required by ERISA. Now, we've listed several notices here. You have WICRA, and I won't describe each and every one of those, but WICRA is a known one, the Women's Health Care Rights Act. You've got certainly PPACA, which is the Affordable Care Act, and then you have all of these others, right, ending here in COBRA and FMLA, these wonderful acronyms, all right? And so what a lot of these documents have, it's more so what they are not providing. They also do not have all of these mandated elements required by ERISA, which is going to include even things such as eligibility and waiting periods. And I want you to also think about just if you have an employer who is an applicable large employer, right? You also need to include the information as to the ACA measurement and stability periods, right? Which is a specific eligibility provision, that was brought on certainly by ACA. Many of these documents do not go into that detail. When's the last time if you have asked your clients if they're an applicable large employer, that you've said, hey, what have you defined as your measurement periods for your for your new hires, or for your ongoing and current employees, right? For those variable hour employees. Do they have it in writing anywhere? Is it in an employee handbook? Well, it's required in the summary plan description and plan documents under and as defined as defined by ERISA. All right, the next bullet here is also assuming, kind of hand in hand, I guess with the previous bullet, is assuming the carrier's certificate is sufficient for purposes of ERISA as a plan document or SPD. It usually is not. Okay, carrier's certificate, they've drastically genericized their certificates today. And generally, they do not have specific client eligibility and waiting periods and provisions. And in many cases, do not address any of the funding under the arrangement specific in that carrier certificate. I will say that I've heard from many employers that they felt that the insurance certificate, the carrier certificate, was indeed the official or required ERISA plan document, and it just simply is not. The next is assuming that the POP document is a wrap plan, all right? So we see this a lot, and of course that's why it's listed here. Employers say, well, I've created a Section 125 plan, premium only plan, or a POP document. We're incorporating all of the benefits that I am offering as an employer, those benefits that are being made being offered on a pre-tax basis, right, through payroll. That's what a Section 125 plan would provide. But they assume that that POP document then is the wrap document. It's not. Section 125, very important. It is still required in addition to an ERISA plan or summary plan description type of a document. But a Section 125 plan or a POP document is a required document for tax purposes, okay? And it's not going to qualify as a wrap document. And then the last item here is the failure to produce documents upon request from the participant or the Department of Labor. So kind of a simple one, right? If you don't have one, you can't produce one. So the refusal to provide one document, right, to a participant or to the Department of Labor, you can ultimately have the result of incurring significant penalties, which can far outweigh the cost of preparing one, which we'll talk about here in a little bit. But many, and I think the Department of Labor states that 3 out of 4 employers are out of compliance with ERISA, all right, and as it even pertains to health and welfare benefits. And so this is where most employers are failing significantly in this area. They just so simply do not have the required documents in hand. All right. So that makes up our top list for the 5,500 document mistakes. Now let's kind of highlight some of the top 5,500 filing mistakes that we see consistently. And I said early on that I was probably a bit naive, felt that, boy, yeah, employers are filing correctly all the time. And we have just found a tremendous amount of mistakes that are being made. These are, you know what, the employer, they didn't know. They didn't know that they were even filing incorrectly. And through research and through analyzing and through certainly our remediation services, we can find out pretty quickly whether specific mistakes have been made. So let's kind of talk about a few of those key filing mistakes. So the first one right here, not filing at all for any non-wrap plans or a wrap plan. So the plan sponsor holds responsibility for knowing about the requirement to file. So you can't use, you know, the answer of, well, hey, I didn't know, right? You know, ignorance is bliss. Not in this case. The plan sponsor holds responsibility for knowing about the responsibilities of knowing how to file and certainly the requirements. So if you've not filed at all for any non-wrapped plans, right, just all of the health and welfare benefit plans that you as an employer may offer today, you need to make sure that you're filing for all plans that would require that specific filing, whether it is a non-wrapped plan, so meaning that they're separate plans, or whether it was a wrap plan where there was one plan document, one plan that incorporated all of the ERISA benefit component plans in one specific document or one plan. The second, and this happens consistently. So an employer will go out and they'll file one 5,500, not understanding or realizing that they don't have or they've not established a wrap plan. And so non-wrapped plans, that means that they're not filing one 5,500 for each benefit plan with employee enrollment over 100. Right? So if you have 100 or more participants at the start of the plan year in that particular plan, that you're going to need to file a 5,500 for that specific plan. You know, it can be for small employers. So I state here, or less than 100 enrolled employees, which fail to meet the exceptions offered under Technical Release 92-01. So again, that applies to the majority of small benefit plans, that specific technical release. I'm not going to take the time to dive into that here today, but there can be some exceptions that apply to small plans, okay? But some small plans would be also required to file. So many of these employers will file just one 5,500 form, not recognizing that they should file them independently because each is their own separate plan. Another key issue, and I put there as a sub-bullet, is that they're not filing using the contract year for a non-wrapped plan. They may be looking at their Section 125 plan document and they say, oh, well, that has a plan year date of, you know, March 1st. You know, of the year. But when you go into the individual benefit components, each plan, each of them can have different contract years. That could be for January or for August or for whatever plan, right? Fiscal, if it's based on a calendar year or fiscal year based plan. So not filing using the contract year for those non-wrapped plans, that's very important. And that's a key mistake that employers are making. And lastly here is filing, last three items here is filing late without the safe harbor of the DFVCP program. So what we do find is that if you fail to use the voluntary delinquent program, you know, that's going to result in maximum fines, okay? And I'm going to show you this example here within our case study. So what many of these employers are doing is that they're filing late. And all they need to do, right, is file Form 5558, which would actually grant them an additional 2.5 months for them to file their 5500. But they're just filing late without that extension. Well, guess what? That is filing in error. And so they would need any date after the required date, which is the last day after the 7th month, right, of the end of the plan year. Then if they file late, a day late, they should have filed that through the delinquent filer program in order to save on potential penalties. Failing to complete the forms correctly. We've had many employers state, oh, no, I filled out the 401k 5500, should be good. I'm good, right? No. I mean, you need to complete a schedule, right? Or the required schedules, A and the like, in regard to each plan or wrap plan that the employer has implemented. So failing to complete the forms correctly is a big deal. A lot of errors and omissions in regard to specific forms. And then lastly, and I did bring this up before, but does need to be stated here again, at least as far as 5500 filing mistakes, that many employers are assuming that the POP document is indeed the wrap plan, and they file under one filing, all right, instead of separate filings that would generally be needed or required based on that particular employer. So that wraps up our top 5,500 filing mistakes and document mistakes. And so, now I'd like to share with you a case study of a specific remediation that we did for a large client. They came to us with many of the errors that I've just described, for you, and we want to discuss how we worked with them to remediate many of these issues. Now, we've also remediated a lot of small clients. So don't just take today's case study and assume that this only applies to large employers as well. Smaller employers are making these similar mistakes, and the penalties are the same whether you are a small employer or you are an employer with significant size. These penalties can actually hurt, right? A lot more if you're a small employer versus a large employer. So let's go ahead and look at this specific case study, all right? And this was a complex one, but we want to share with you kind of all the little intricacies of this particular case study. So what had happened was there was a large manufacturing company. This came to us from a broker partner of ours. They requested assistance from our ERISA team, and the broker had begun to recognize with this existing client that there seemed to be many complex problems regarding their ERISA required Form 5500 filings. Now, they did have more of a complicated business structure, okay? They were in multiple states. There was, multiple brokers. There was not just, one broker that covered the broker of record for everything that was offered. As we looked back over the last, decade, right? There can become many changes in that department. There were many carriers over this period that we needed to review. And also, just like every employer, right, they make changes from year to year. And so the class of employees changed over the years as to who was eligible, who was not eligible for those certain benefits. All of that changed. And, part of that could have been because of just ACA, right? The Affordable Care Act that was introduced here prior. We noticed that Form 5500 for the 401k plan was filed each year, but the health and welfare forms 5500 were not filed correctly. This is consistent with what we see. We see a lot of great, accuracy and timing as it relates to the 401k plan, but not that same attention to detail as it applied to the health and welfare benefits. And so just multiple concerns were identified, all right? And, clearly based on their size, it would provide for a great potential for the Department of Labor to actually come in and perform an audit. Now, some things to note. We're going to share some additional items here going back even over a 9-year to almost a 10-year period. But if an audit were to happen, the Department of Labor typically only looks back 3 years. So that's general, all right? That's pretty typical. However, there is no statute of limitations as to how far back they can actually look. So in performing our remediation services, we need to kind of provide as much information as we can, right? That way, as an employer, they're going to make the most informed decisions that are needed. So after our initial introduction to the client, discussing the errors that we saw on the face of the past filings, to be safe, the broker and the client requested that we conduct a full review of the previously filed Forms 5500 available on the Department of Labor site, as well as broker provided materials dating as far back as 2009. This review presented significant challenges as PrimePay. We had to reconstruct data and obtain required documents like Schedule A's, spanning back almost a complete decade, right? So let's go into some errors discovered. The first thing that we noticed in all of this was that there was an absence of an ERISA wrap document. There was a presumption that their Section 125 document served as their wrap document, all right? So this was a large employer. They had a full HR team, benefit team, right? But this presumption that Section 125 was kind of their piece of the puzzle that would grant them that wrap status, that was a big deal, which means, right, that they were not filing correctly. They were filing as a wrapped plan, but they indeed did not have that. So that's not permitted. You can't bundle those benefits together if you do not actually have that wrap document. There were also delinquent filings, and we noticed that there were delinquent filings that were not far beyond the actual deadline for their plans. But many of their plans were filed late without filing a Form 5558, which would have granted them an additional 2.5 months worth of an extension, right? And so without a wrap, all right, bundled plans on the 5500 are deemed to be not filed at all. So you might say, well, Steve, no, they filed them late. Well, no, see, they filed it as a bundled plan, as if they had a wrap document. But because they didn't have a wrap document and filed it as one plan, it's actually deemed by the Department of Labor as to have not been filed at all. And so these plans that they had filed for, believe it or not, were subject to significant penalty unless they had filed under the delinquent filer program. Plan years and contract years. So think of this as well. They were filing this as under the reference of a wrapped plan. So the plan year that they were using for the wrapped plan was actually out of kilter, right? It was not even remotely correct as to the actual contract years of their plan. And so in absence of a wrap, the individual plan's contract year should be used. Again, unless certain tax situations would apply, it did not apply in this case. So due to the complexity of this plan, the asynchronous nature of the plan year used on the 5500 and the contract year caused gaps in the filings. So just kind of think about that, right? Their dental plan, their vision plan could have been on the same plan year as their Section 125 plan, but there were different benefit components or plans that were on a different year, and so therefore they had filed those incorrectly. There was also improper completion of information related to their self-insured plans. So the improper use of their Schedule C, they had a failure to designate the general assets. It's very important, right? In ERISA, not only is it important to communicate benefits, right, the distribution of information to the employees and their beneficiaries, but you also need to state, how the funding is going to occur. So failure to designate appropriately the general assets and using the stop loss coverage on Schedule A was also a big error that was discovered. And then the inclusion and exclusion of benefits. Listen, over 9 years and the complexity of their benefits, there were some plans that were included on the 5500 with no Schedule A, and some were excluded, but a Schedule A was attached, right? So just inconsistencies kind of across the board. And a lot of that was just really due to their presumption that the Section 125 plan was really including all that was necessary for their filings. And then there were just standard, I'd say simple, but still meaningful, general omissions and errors that had occurred. So there's a lot there, right? We now had looked back to over 9 years worth of filings and plans and information. So what did we end up doing as part of a remediation? What did we recommend? We had asked that they do an amendment of all their original filings. And based on what was seen throughout our analysis, we needed to reflect the medical plan only. And so that meant we needed to correct the Schedule Cs and the self-insured errors that persisted over the years. And then the big one, right, was the correct contract years. So we needed to amend these original filings to ensure that going forward, right, 2018 and 2019 beyond, that we actually are filing in the correct contract years, that we had. So a contract year. So again, think about this. In the absence of a document establishing an official plan year, it should be assumed that the contract year constitutes the plan year for purposes of the 5500. Otherwise, think about this, an employer could declare that they were not late in filing because they established an arbitrary plan year which did meet the deadline. So without a written plan instrument or document, that would not hold up, right? So it was important for, as we looked at them thinking that their Section 125 plan was actually their wrap plan, that's what was throwing off all of these contract years. So, the plan document was going to come into play here in regard to the amendment of those original filings. So creating 10 new plans, they had filed under one. We needed to create 10 new plans to address these other benefits using the DFVCP program. So there was a careful evaluation of all the contracts and plans, and then we did push them to pursue the DFVCP protection because why? It caps penalties at $4,000 per plan instead of a potential maximum penalty of tens of millions of dollars. And I'm going to show you here that part was pretty significant. We then needed to prepare timely filings here to sync things up. We needed to incorporate a short plan year and then a final filing designation really to synchronize with a wrap plan year, all right, going forward. And then ultimately, right, we need now to officially incorporate their benefits into a wrap plan document and a summary plan description to unify all of the plans and certainly to eliminate multiple filings going forward, which keep in mind, right, instead of doing 10 plans per year, we now are going to be able to incorporate that under one filing per year. Significant opportunity to not just reduce costs, but just the complexity of that. So this comes to our outcomes. I want you guys to look at some of these numbers here for a minute. So we did a full analysis and a remediation report was prepared for this client. And I want you to think about what the penalties would be if we had not recommended the DFVCP program. All right, so just think about this here a second. The maximum penalty without that program for one plan over just the span of 1 year, the penalty is $2,194 per day per plan. So one plan would equate to over $800,000 worth in penalties. So now let's take that a little further. One plan over 9 years, because that's how far back we went for this particular client, would cost in a maximum penalty of $7.2 million, and then take the number of plans that they ultimately had, which was 10 plans over 9 years. That equated to maximum penalties of $72 million. And again, this penalty has no look at the size. You are an employer with a couple thousand employees. You are an employer with 52 employees. All right, number of plans over a number of years that you filed incorrectly, that can cause those penalties. All right, now clearly, the Department of Labor does not have to implement the maximum penalties. There can be negotiations that will persist with the Department of Labor, but just know, based under the current rules, that's what the maximum penalty would be. For this employer to utilize then the DFVC program with a maximum penalty of $4,000 per plan, right, per year, those 10 plans over 9 years only equated to $34,000 in penalties paid through that program. So ultimately, through our remediation, we completed over 8 amendments. We filed over 55 delinquent filings. They were prepared and filed for the client. As you can see, we drastically reduced the penalty exposure for this employer. And ultimately, we were enabled to sync up their correct contract years, and we were able to create a wrap plan document for the 2018 plan year, which now allowed for one filing for 2018, which would then which was due here July of 2019, and now only filing once per year. What a difference. So the result, right? Client right now is fully in compliance with ERISA. So it's very important to explain to clients the requirements for filing and make sure that they know about not just, when they must file, but also if filed incorrectly, they need to know about this DFVC program in case they did not. So many of you might be thinking, as a benefits broker, you have been working with your clients. You have some clients that have been with you 1 year, 5 years, 10 years, longer, right? Long-term clients. Have you ever once introduced this type of subject, this topic to your employers? So you might be asking yourself, well, Steve, how do I address this compliance with my clients? Aren't they going to say, well, where were you 2 years ago? Where have you been? Why haven't you brought this up before? Look, as you can see with this previous client, this broker who had been working with this client for some time just had not been addressing those specific components. And let me just tell you, saving a client $72 million, I would say, is a win for that broker. So you do need to bring it up. Don't hide it. Do not talk about it with your clients. So here's just some key questions that can be asked. And I won't go into real strong detail because I think the webinar here today has kind of laid out some of the key reasons why you want to ask and address these questions. The first one is a simple one, and it goes to ERISA 101. Client, if a Department of Labor auditor were to walk into your office today and they would recognize that you're offering a medical benefit, an employer-sponsored medical benefit to your employees here today, they're going to ask you, do you have your document? I'd like to see your plan document and your summary plan description. If that were the case, employer, could you produce one today? That's a great starter question. And that really can begin a lot of the, well, honestly, good conversations. I know they can be hard conversations to some degree, but they can be good conversations to have. So do you have a wrap document? Simple question, but can open up and push that conversation in myriad different ways. Have you ever filed a Form 5500 for your health and welfare plans, right? So you could be a small employer that do not fit the specific exceptions, or you could certainly be that large employer. And I want you to think about your larger employers, certainly those that have 100 or more employees. Keep in mind that those employers, those specific benefits, maybe only one or two of them have 100 or more participants at the start of the plan year, and the others do not, right? You might be a broker of record on some, but not all of the benefits being offered. So asking this question, right, or these next two, have you filed a Form 5500? It's going to tell you, hey, what's your tendency here? Have you been filing? Oh, no, I have. Great. That's a great, that's going to open up the next series of questions of, if so, were they filed properly? If not, should you have? At any time, have you met the specific criteria for you to file? You may be thinking, employer, oh yeah, I file 5500, and they're just thinking about their retirement plan, their pension benefits, but they're not necessarily thinking about the health and welfare side of it as well. I want you to also think about self-insured plans. Certainly for many groups over 100, they're going to have self-insured or self-funded types of plans. And it's important that you're including specific aspects, including like stop loss on Schedule A. Did you include the Schedule C? And it all depends on how that employer is funding the benefits. Employer, that's a self-insured benefit. Are you funding that solely out of your general assets or in some other capacity? Do you have a trust or something else that may be funding that? And then the last question here, were they filed on time? And if not, were extensions filed, or was the DFVCP program utilized? Again, if it's a day late, they should have filed an extension. And if it's a day late, that means they're out of compliance. All right. It would be as if that filing had never occurred, believe it or not. Right. So that DFVCP program is going to be or want to be utilized, or it's easy. File a Form 5558 and get that additional 2.5 months, so that there's sufficient time for them to file their returns. I do want to update you on the increase in penalties. This gets updated generally yearly. Generally, these come out at the beginning of the calendar year, but just to kind of highlight 4 key penalties that the Department of Labor updated here at the beginning of 2019. Failure to file an annual report, that is $2,194 per day. All right, so that's per day for the failure or refusal to properly file a plan. All right. The second is failure to provide documentation, and that is now in 2019, $156 per day for each failure to provide requested information. The next, $117. So the failure to provide a chip notice is the penalty is $117 per day per employee. All right, so just think of that number. All right, per day per employee. How many employees did you fail to provide that notice? You could be hit with $117 per day. And then lastly, what I show here is the failure to provide a summary of benefit coverage notice, right? The carriers provide this generally, but it's up to the plan sponsor, it's up to that employer to distribute that SBC notice. And that penalty is $1,156 per employee for failure to provide that SBC notice to your employees. So as we stated there early on, ERISA, it is real life. These penalties can be really felt and can really impact. Think of that employer with a $72 million penalty. If the max were to have been imposed on that employer in any type of an audit, I mean, that could be a company diffusing, that company can be eliminated, right, based on that penalty. It's that severe. And if that was a smaller business owner that was being hit with that type of a penalty, they're going out of business, right? So ERISA is real. And I want you to just think about your consistent daily conversation that you have with your clients, and do incorporate this ERISA conversation as part of your normal business conversation that you have with your clients. You are experts in the benefit world, and this aspect of ERISA is a key component, a key compliance requirement that needs to be attached with every bit of your conversations. Let's make sure that your clients have laid the appropriate foundation, and they're continuing that through proper filing and through proper updates in their plan documents to ensure that they are managing ERISA compliance at the highest level and current level. So I am thrilled to be able to provide this detail to you here today, this content. If you'd like more information about how PrimePay is getting involved in helping brokers and their clients with ERISA compliance, please reach out to our Broker Concierge Partner Program at the numbers listed here. We also have additional content that can be provided to you, and you can find that on our YouTube channel. It's our Broker Concierge channel, where you can find many videos on this subject and content on many other, specifically on our Broker Concierge YouTube channel. So with that, that will conclude our webinar. If you have additional questions, please reach us at one of the vehicles there listed on the screen. But we thank you for taking time to listen to our topic today. Have a great day.